Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Thursday, March 5th, 2026, and we're here to dive into the latest market buzz based on yesterday's insights.
That's right, Ethan. Our AI dug through a significant number of posts yesterday, flagging quite a few different stocks. The overall market sentiment we're seeing today feels a bit mixed, I'd say. A lot of strong opinions out there, leaning towards cautious.
Definitely, Brooke. But, mixed sentiment can often hide some real gems if you know where to look. Let's dig into some of these.
All right, let's kick things off with Walmart, WMT. We saw 11 posts on this one, and the big discussion point was actually a question. Someone explained why Walmart is at 47 times earnings.
Well, for a giant like Walmart, WMT, that 47 times PE ratio certainly raises eyebrows. But I think what users are missing is the strategic transformation underway. We're seeing news about next-generation supercenters, an expansion in their e-commerce game, and the strong performance of ventures like PhonePe in India. These aren't just a traditional brick-and-mortar retailer anymore. They're expanding into digital, ad revenue, and leveraging those massive real estate holdings. That's long-term growth potential.
I hear you, Ethan. But let's be realistic. A PE ratio of almost 47 times earnings for a company with a 5.6% revenue growth rate, that's incredibly high, historically speaking, for a retailer. Our KPIs also show a price-to-book ratio over 10, meaning the market is valuing it way above its tangible assets. And to really put a dampener on things, insiders have been net sellers, offloading over 10 million shares in the last 6 months. That suggests people close to the company might feel it's fully valued. When we last looked at WMT in February, it was a stay away. Based on these KPIs, despite the growth initiatives, I don't see enough to change that.
I still think those e-commerce and ad revenue numbers could surprise, but I see your point on the valuation.
For WMT, the current valuation, those insider sales, and that P/B ratio just scream caution. It's a solid business, sure, but the stock itself seems priced for perfection. So for Walmart, we're going to have to classify this one as stay away.
Fair enough. Next up, let's talk Microsoft, MSFT. We saw a lot of activity here, 70 posts. One notable one was MSFT slander no more, with someone making a highly bullish options bet.
Oh, Ethan, that options bet was indeed aggressive, and the comments were not shy about calling it out. The sentiment was leaning bearish to neutral, with a lot of skepticism. My main concern, even for a tech giant, is that PE ratio of over 25. While it's certainly not 47 like Walmart, for a company of Microsoft's size, that means significant growth is already baked into the price. Some news also points to analysts downgrading it and Jim Cramer expressing worries about AI profitability.
But you have to look at the underlying fundamentals, Brooke. MSFT is consistently delivering strong revenue growth at 16.7%, a phenomenal net profit margin of almost 40%, and a return on equity exceeding 34%. They're pouring money into OpenAI, securing strategic wins, and focusing on integrating growth into their gaming division. These are the hallmarks of a company that will continue to innovate and grow for years. Plus, there was a net purchase of over 75,000 shares by insiders, which shows internal confidence. They've traded significantly higher in the past, up to $555.45 in the last 52 weeks, so the potential is there. We've rated MSFT a buy many times, even as recently as early March.
The fundamentals are undeniably strong, Ethan. The revenue, profit, ROE, they all paint a picture of an incredibly robust company. But the market commentary regarding the high PE and concerns about AI profitability means that while the company is a powerhouse, the stock's immediate upward trajectory might be more challenging. It's a bit of a downgrade from our previous buy rating. The high PE requires continued strong execution, and the current price is a good distance from its 52-week high, suggesting some headwinds.
So for MSFT, you're suggesting?
I'd say cautious buy for long-term investors who believe in its sustained fundamental strength and are comfortable with its current valuation, but definitely stay away from those aggressive short-term speculative bets.
All right, cautious but still on the radar. Finally, let's discuss ADP, Automatic Data Processing. Only 10 posts, but a lot of buzz around their job report.
Buzz, maybe, but mostly negative, Ethan. The analysis showed a strongly bearish sentiment score of -7. Users were overwhelmingly skeptical, calling the job numbers fake and pumped up, expecting significant downward revisions. This directly impacts ADP's core business credibility. While ADP itself has strong financials, 6.2% revenue growth, a 20% net profit margin, and an amazing 73% return on equity, the stock's current price of $217 is significantly closer to its 52-week low of $203 than its high of nearly $330. It's been in a clear downtrend. True, the user sentiment around their job reports is very critical, but ADP is doing more than just reporting numbers. They're expanding their AI agent marketplace, which shows innovation and potential for future growth in their service offerings. They also offer a respectable 3.13% dividend yield. For a fundamentally sound company, these things tend to eventually shine through. We last rated ADP a stay away back in October 2025, but the innovation news could be a game changer. The dividend is attractive, and those efficiency numbers like ROE are stellar. But a PE of almost 21, even after a significant price drop, doesn't scream bargain when the market is actively questioning the reliability of the core data they produce. That widespread skepticism about their job figures, combined with the clear downtrend in the stock over the past year, creates a significant risk. If the market continues to distrust their reporting, it could erode confidence in the company, regardless of their AI efforts.
So, despite the strong internal numbers,
the market perception and that clear downtrend make ADP a stay away for now. There's just too much doubt overshadowing their good financials.
All right, Brooke, time for our final roundup of today's market insights. Investigate as buy, none. Investigate as cautious buy, Microsoft MSFT. Investigate as speculative gamble, Walmart WMT. And that wraps up another episode of the Daily Hunt for Multibaggers. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in. We'll catch you next time for more market insights.